Last week, $119 million flowed into XRP investment products. That is the strongest weekly institutional inflow since December. But here is the detail that should stop you cold. 84% of that money came from Europe. Switzerland alone contributed more to global crypto fund flows last week than the entire United States. And while European institutions were accumulating XRP at levels not seen in months, American investors were net sellers. $31 million in outflows on the same week, in the same asset. Two groups of people looking at the same price chart, reading the same headlines. One is buying aggressively, one is selling. That gap is not a difference of opinion. That is an information gap. Somewhere between Switzerland and the United States, a piece of analysis is being read by one group and completely missed by the other. And in financial markets, information gaps have only ever resolved one way. The people who are wrong find out after the price has already moved. Today, we close that gap. Welcome back to XRP News Flow Signals, where we track capital flows, not just price action. This is not financial advice. Always do your own research. But if you want to understand exactly what European institutional capital is reading that American retail investors are missing, and why that gap will not stay open for much longer, stay with me. Let's map it precisely. Let's start with the hard truth that the geographic split in XRP flows reveals. When two groups of market participants behave in opposite directions on the same asset at the same time, the question is never who is right in the moment. The question is who has better information. An institutional capital, the kind that moved $119 million in a single week through regulated European fund products, does not flow at that scale on sentiment. It flows on analysis. So what are European institutions analyzing that American retail is not? Start with the supply picture, because this is where the data becomes structurally alarming in a way that price charts alone cannot capture. XRP exchange reserves just hit an 8-year low. Only 1.6 billion tokens remain on exchanges, down from 3.76 billion in October 2025. That is a 58% reduction in available liquid supply in roughly 6 months. At the same time, XRP ETFs have locked up 746 million tokens in under 2 months. At the current inflow rate of $27.7 million per day, total ETF assets could reach $5 billion by mid-May 2026, locking nearly 2.6 billion tokens, approaching 4% of total circulating supply. Two separate mechanisms removing supply simultaneously. Exchange reserves draining from long-term holders moving to cold storage. ETF custody absorbing tokens that will not return to the tradable float as long as those shares are held. Now layer on the whale flow signal. XRP whale flows just turned positive on the 30-day moving average for the first time since November 2025. That is the same technical setup, the same behavioral configuration of large wallet accumulation that preceded the run to $3.65 in the previous cycle. This is not a chart pattern. It is an on-chain behavioral pattern. Large holders are net buyers again, after months of distribution. And when large holders accumulate while exchange supply is at an 8-year low, the math of what happens when new demand arrives becomes structurally different from any previous entry point. European institutions are reading this supply picture. They are reading the whale flow data. They are reading the on-chain exchange reserve drain. And then they are writing checks. The American retail investor refreshing the price chart at $1.37 is not reading the same document. That is the information gap. Now let's run the numbers that make the European institutional thesis not just logical, but mathematically inevitable at scale. Start with the macro context that most crypto analysis never touches. U.S. government interest expense in the first 6 months of fiscal year 2025 hit $623 billion, the highest for any comparable period in American history. At current interest rates, the U.S. government cannot service its debt without structural economic damage. There are only two policy exits: Lower rates or expand the money supply. Both paths produce the same outcome: currency devaluation and liquidity expansion. This is not a prediction. It is arithmetic. And it's the same arithmetic that has driven institutional capital into fixed supply assets in 2008, 2020, and every previous liquidity expansion cycle in modern financial history. Now layer on the oil shock. Brent crude hit $103 per barrel last week, up 11% in a single week, as Strait of Hormuz tensions disrupted global supply chains. When oil spikes at this velocity, central banks face an impossible choice: raise rates to fight inflation and break the economy, or hold rates and watch purchasing power erode. The NFIB Small Business Optimism Index fell to 95.8, the third consecutive monthly decline, now below its 52-year average. The Uncertainty Index jumped to 92, the highest since September 2025. This is the data the Federal Reserve watches. This is what tells them the economy is weakening while inflation is simultaneously rising. The policy trap is set. And when the Federal Reserve cannot raise rates without breaking the economy and cannot hold rates without accelerating inflation, the historical answer has always been liquidity expansion. Now connect that macro setup to the XRP supply picture. At current prices around $1.37, moving $1 billion through the XRP Ledger requires approximately 740 million tokens. At $10, the same billion-dollar settlement requires 100 million tokens. At $50, just 20 million. The system functions more efficiently, generates less slippage, requires less liquidity depth at higher prices. This is not a price prediction. The institutional settlement use cases that Ripple has been building toward for years: cross-border payments in a $150 trillion annual market, daily forex flows of $7.5 trillion, and $27 trillion locked in Nostro Vostro accounts that tokenization could free, all become more operationally viable as the token price reflects the settlement scale it is being asked to handle. European institutions have done this math. That is why 84% of last week's inflows came from their side of the Atlantic. The American retail investor has not done this math yet, but the supply will be gone before they finish the calculation. Let's talk about what Goldman Sachs is doing, because this detail sits at the intersection of the European capital story and the American regulatory picture in a way that most coverage completely misses. Goldman Sachs is now the largest disclosed U.S. institutional XRP ETF holder, with $153.8 million in XRP exposure across 4 separate funds. Goldman analysts described this positioning as likely reflecting trading desk facilitation, meaning Goldman is not simply taking a directional bet on XRP price. They are positioning to service client demand they expect to grow. Goldman builds positions ahead of client flows, not behind them. When their trading desk is accumulating XRP ETF exposure, it means their institutional client flow desks see inbound demand that is not yet materialized publicly. That is a forward-looking signal from one of the most sophisticated client demand forecasting operations in global finance. Now connected to the Clarity Act picture, because the regulatory variable is the single mechanism that would unlock the American capital that European institutions are not waiting for. JP Morgan's latest analysis has narrowed the remaining Clarity Act issues to just 2, down from more than 10 contentious points several months ago. A Senate staffer described the current draft as very, very close. A survey of 351 institutional investors found that 65% cite regulatory clarity as the single factor holding back their XRP allocation. Not technology concerns, not valuation concerns. One variable: regulatory classification. When the Clarity Act passes and XRP's commodity status is codified in federal statute, that 65% does not gradually enter the market. It enters in the compressed window immediately following passage, when compliance departments simultaneously greenlight allocations that have already been analyzed and internally approved, pending only the legal trigger. The European institutions are not waiting for that trigger. They are front-running it. The American institutions are waiting. And when they move simultaneously against a supply picture that is already at an 8-year low, with exchange reserves at 1.6 billion tokens, with ETFs locking an additional 2.6 billion by mid-May, the supply simply will not be there at current prices to absorb that demand. That is not a projection. That is the mechanical consequence of fixed supply meeting compressed inventory, meeting triggered institutional demand. I want to pause here because mapping the European-American capital split to the exchange reserve drain, to the Goldman positioning, to the Clarity Act trigger as a single connected thesis, rather than 4 separate data points, is the kind of cross-market structural analysis that this channel is built to deliver. If you want this level of signal mapping in your feed consistently, subscribe to XRP News Flow Signals right now and turn on notifications. Because the catalyst timeline I am about to map has specific dates attached, and the window between the Clarity Act passing and the price reflecting 65% of institutional demand entering simultaneously is the only window that has ever mattered. Let's be precise about the convergence ahead, because the data points from this week sit on a visible, sequential trigger timeline. Catalyst 1, Clarity Act Senate Banking Committee markup, targeted for late April into early May. 2 issues remaining from 10+ months ago. Senate staffer language, very, very close. When markup occurs, the voting phase begins. When the bill passes, 65% of institutional survey respondents who have already done their analysis and are pending only the legal trigger enter simultaneously. Catalyst 2, ETF supply lock acceleration. At $27.7 million in daily ETF inflows, total XRP ETF assets approach 5 billion by mid-May, locking approximately 2.6 billion tokens from the tradable float. That absorption happens regardless of the Clarity Act. It is already in motion. Every day of inflows at current rates tightens the supply available to meet post-Clarity Act demand. Catalyst 3, Federal Reserve liquidity response. NFIB at 52-year average, oil at $103, interest expense at historic highs. The macro conditions that force liquidity expansion are assembling simultaneously. When the Fed pivots, historically the event that triggers the broadest rotation into fixed supply assets, the supply picture will already reflect 6 months of institutional cold storage accumulation. Catalyst 4, whale flow confirmation. Positive 30-day moving average for the first time since November 2025. The same behavioral configuration that preceded the run to $3.65. On-chain confirmation that the distribution phase is over and the accumulation phase has begun. 4 catalysts, all on a visible, compressing timeline, none requiring speculation. Here is the supply arithmetic that closes the analysis. 1.6 billion tokens on exchanges, the lowest in 8 years. 746 million already locked in ETF custody, growing daily. 58% reduction in exchange reserves since October 2025. 65% of institutional capital waiting on a single regulatory trigger. When that trigger fires, when the Clarity Act passes and compliance departments simultaneously greenlight allocations that have been internally approved for months, the demand enters a market where the supply to absorb it has already been removed. European institutions understood this math in January. The American retail investor is reading this sentence right now. The supply that existed when Europe started buying is already gone. Let me leave you with the frame that makes all of this land correctly. 2 groups, same asset, same week, same headlines. Europe, net buyers, $119 million, 84% of global XRP fund flows. America, net sellers, $31 million in outflows. That gap is not a difference of opinion. It is an information gap. And information gaps in financial markets have only ever resolved one way. The side with better information is proven right when the price catches up to the analysis. The European institutions read the 8-year exchange reserve low. They read the whale flow turning positive. They read the Goldman positioning. They read the Clarity Act narrowing to 2 issues. They read the macro setup forcing the Fed's hand. And then they bought. The American retail investor read the price chart and saw sideways action. One of those reads will be proven correct. The supply available at the time of that proof is already significantly less than it was when Europe started reading. If this analysis closed the information gap for you, subscribe to XRP News Flow Signals before the Clarity Act markup lands. We track the flows, the supply, and the legislative mechanics before the price reflects them. Drop one word below, Europe, if the geographic split reframed how you see this moment. Let's see who caught the signal. Stay sharp. The signal does not lie. Not financial advice. Always conduct your own research.